everybody, and welcome to Chelsea Groton Bank's Money Madness. We are excited to kick off the event in a virtual setting this year. I'm going to continue letting people in as we trickle in this morning, as it's early on a Monday. There's a couple of just points of interest I'd like to get out of the way before I introduce today's speaker. The first thing is, if you're watching this after the fact, you can tune in to our Instagram page, and every day there'll be a question on our Instagram page that you can answer. And if you answered it, you will be eligible to be put in a drawing for a gift card. So definitely be checking out our Instagram page for the question of the day. And our Instagram is at Chelsea Groton Bank. And make sure that we can know who you are. So tell us what high school you're coming from so that we can contact your teacher to get them your gift card. So, give us your answer and then say, Griswold or NFA or Montville, whatever it might be. The other thing is, for those of you that are watching live today, if you're home and we would like to see your cameras on, if your cameras are on, you will get a ticket with your name on it. So make sure your name on the screen is how you're identifiable. So your name on the screen, your camera on, that'll earn you a ticket. Even if your camera's on, you will not be recorded. So no worries there. The other way that you can earn tickets is by asking a question. So you can type questions into the chat box and we will be happy to answer those for you. Answering questions, cameras on for my live people will get you tickets. All right. Money Madness is clearly a little bit different this year. Normally we would all be together and we would be going around, but we're really excited to try it this way this year. So I am continuing to let some people in this morning. Welcome everybody. And again, we are kicking off Money Madness. We have a very special speaker this morning who is going to be speaking to you about credit, which is really important as you guys are getting older, turning 18 and getting all of those requests in the mail. We have Rashea Schand from the Money School with us today about credit. So without further ado, first I'm going to remind everybody.
Oh yeah. So this.
Yeah, but you have to mute yourself or else they can share us.
I'm going to mute everybody so that we're not hearing classrooms. And then just a couple of informational things as we are getting going is cameras on, get you a ticket. Tickets will be entered into a drawing for gift cards to Amazon and Dunkin' Donuts and Starbucks. Tickets at the end of the week. We usually spend quite a bit of money on Money Madness. So at the end of the week, we'll be doing some drawings for some very large denominations of gift cards. Everybody's tickets will stay in the basket if you earned a ticket this week. And we'll do a drawing at the end of the week for everybody who has a ticket in the basket to win some larger gift cards. So again, cameras on earns you a ticket, and questions earns you a ticket. If you if you are watching this after the fact, you can check our Instagram page at Chelsea Groton Bank. And there'll be a daily question there. If you answer it and tell us what high school, we're going to do a drawing for gift cards from there. for those people who are not with us live. And those people will also be entered into the drawing for the end of the week. So make sure we have a name and your handle's not like Cutie Bunny or something like that, because I don't know who that is. Okay, so without further ado, I'm going to turn it over to Rashea Schand from the Money School. Good morning, Rashea. Thank you so much for joining us today. Oops.
Let me myself. Good morning, everyone. I'm excited to be here. Yes, it is very bright and early. I was just sitting here thinking, like, I've been out of high school for about 15 years, and I do not remember getting up this early for class. It's definitely been a while. So I commend you guys for showing up, for being here to learn about money. Just a quick introduction about myself. As Mary mentioned, my name is Rashea Schand. I am a wife and mom of 4. I was born and raised in Hartford, Connecticut. Been here all my life. I graduated from Delaware State University with a degree in business management and finance. After graduating from college, I came back home to Hartford, and I was working in the insurance industry for about 10 years. Up until 2020, when the pandemic hit, I was in insurance, but then I decided to leave my job and take care of my family full-time. So I'm a full-time stay-at-home mom. I also operate and run 2 businesses, a fitness business. I'm a group fitness coach, and I volunteer to teach high school students about money. I also have my own business, helping prepare high school students for life in the real world. So let's get into it. This morning, we're going to be learning about borrowing and credit. A topic that you guys probably think is, way down the line, after I graduate from college, once I get my dream job, but learning about credit and borrowing is so essential right where you are before you graduate high school. Like someone mentioned before, you're going to start to get offers in the mail. Right? You're going to turn 18 and you're going to start to get credit card offers in the mail. So I think it's important to learn how to play the game, learn the importance of credit and borrowing, the do's and don'ts and things like that. So again, welcome, welcome, welcome. And I'm excited to be sharing this information with you all. For some of you who don't know, I'm currently volunteering for Cass Connecticut Money School. And this organization is pretty much all about empowering our community, teaching them the basics of financial literacy. So am I just sharing my PowerPoint? That's all everyone has. They don't have any other materials and things like that. Okay, so this one's a little different. All right. So for today's workshop, we're going to be learning about credit. We're going to learn about what a loan is. We're going to identify the different types of loans and borrowing, understand the difference between secured and unsecured credit, and pretty much the cost of borrowing money and the factors that lenders look when they're deciding whether or not to lend you money. Credit is essentially borrowing money from someone with a promise to pay them back. And I'm sure some of you have experienced this before. You got a cousin, a friend that says, let me hold $10 to buy something to eat. You may use Cash App or Venmo these days to send them money. And it's like, you send them that $10 and you expect them to pay it back. That's pretty much what credit is. You're borrowing money from someone with a promise to pay them back. In the world of finance, that someone is called a grantor. It's a lender, usually a bank or some type of financial organization that says, I'm going to lend you money. The big difference between you lending your cousin money and a bank lending someone money is the fees and the interest they charge. So typically, if you Venmo or Cash App someone, you're not going to charge them interest. You're not going to say, okay, you spent $10 at Chipotle. Now I want you to give me $15 back. No, you're going to get your $10 back. But when it comes to the financial world, these banks are not friendly. They're not just out there saying, yay, I'm going to loan Brendan $1,000. No, they're going to say, I'm going to loan Brendan $1,000, but he's going to have to pay for this $1,000. This ain't free money. So what banks do is they charge you interest and fees for using their money. And before they even decide that, they want to know that they can trust you. Credit equals trust. So I let my friend borrow $10. Now, you know your friends and your family members better than anybody else, right? And you probably wouldn't lend $100 to your cousin or friend who's always lying, your cousin or friend who doesn't show up to school, who doesn't turn in their work, who's not responsible, right? You're probably going to give them a side eye, or you're going to think about it before you let them borrow that $100, right? And that's what lenders pretty much do. They look at your behaviors. How do you behave? How do you manage money before they decide to give it to you? So again, credit equals trust. And when lenders decide whether or not they're going to loan to you, they want to look at your past history, your behaviors, and things like that. Why credit is important. So you guys are all in high school. I'm sure you guys have some big dreams. One day you may want to own your own home. I hope that's one of your goals. Some of you may go to college. Some of you may not go to college. You may pick up a trade and you may get a job right after high school. But guess what? In order to get that job, you may need a car to get back and forth and to and from work, right? So you may have to buy a car. So credit allows you to borrow money to make big purchases that you may not have the upfront funds for, right? If I get a house, I'm not going to have $250,000 upfront. I'm going to need to borrow that money. If I have a car, buy a little starter car, may cost $7,000 to $10,000. I may not have that upfront. So credit is not always bad. It's something that you may need to help you get your life on track or help you pursue your dreams and goals, right? It's also useful in times of emergencies. Last year, 2020 was crazy. Nothing was stable. Finances was all over the place. Jobs were all over the place. And sometimes you need to borrow in times of emergencies, right? So scroll up. If managed well, credit can positively affect your ability to obtain employment, housing, and insurance. So one thing you guys should know, when you're applying for jobs, employers look at your credit history. Again, remember, credit equals trust, and it looks at your behavior. So they want to know, okay, if I hire Bailey, is Bailey responsible? Is she going to show up to work on time? And how do they determine that? You know, they're going to determine that obviously by your interview, but they're also going to look at your past history. How many other jobs does she have? How long was she at those jobs? And then how well does she manage her credit? So credit is important for employment as well. And again, housing. If you decide to move out with your parents' house and one day you decide to rent, landlords are going to look at your credit. You know, I'm a current landlord and I own a property. And one of the things I look at before deciding to rent to that tenant is, how does their credit score look like? How is their credit? And think of, when I say credit score, think of it as an ABCD, right? You're all in high school. You get a score based off of the work that you do or not do. Some of you may be A students, B students. I hope none of you are D students. But that's how creditors look at you. You know, A students are those who, or A credit scores are those who pay their bills on time, who don't rack up a whole bunch of debt. They manage it responsibly. So that is why credit is important for you guys. What borrowing means? So lenders provide you with money, right, that you have to pay back with interest. We already established that. You're borrowing money, but it's not free. You got to pay it back with something on top of it. So just some key concepts for you guys to remember is, one, credit is the ability to borrow money, and debt is money you owe a person or business. So if I get a car loan for $10,000, at the end of the day, when I look at my financial summary or portfolio, I'm going to owe a debt of $10,000. Now, debt, you'll hear mixed things about debt. You know, some people will say, don't get into debt at all. Debt is bad. But sometimes you need to get into debt in order to secure a better financial future. Who wants to go to college, right? I'm sure everyone wants to go to college. Some of you guys may have parents that are wealthy and can pay for your college up front, but some of you may not. So a college education is very expensive, and you may have to go into debt in order to go to college. But the key is to be responsible with that debt. Should I go to get a college degree that costs $150,000, but then my career right out of college is only paying me $45,000? That may not be a wise decision. So there's always a cost benefit analysis that you guys should do before you decide to borrow. And we'll talk about that a little later. Again, I want this to ring loud in your ears. Credit is not free. There's a cost associated with borrowing. And here's a quick breakdown of what I mean by that. So, for example, I purchase a car, let's just say a $10,000 car, Honda Accord. That's the principal. The principal is that $10,000 that the car is worth. Well, not what it's worth, what they're selling it for, right? Plus interest. So again, principal is the money you borrow, and then the interest is the amount the financial institution is charging you to borrow that money, plus any applicable fees. So at the end of, say, a 5-year car loan term, at the end of that term, I may end up paying back $13,000 or $15,000 for that Honda Accord. That is very important to understand. You want to understand what the interest rates are and what the fees are that lenders are charging you, because at the end of the day, what you thought was a $10,000 car can now be a $15,000 car. You got to say to yourself, was that Honda Accord worth $15,000? So always do that analysis. Another reason why credit is important is because when lenders look at your history and, you know, your past behaviors, they're going to say, okay, this A student, I'm going to charge her 10% interest, right? But this C student, I don't know if I can really trust her. She's a little iffy. So I'm going to charge her 18% interest, right? So the better your credit is, the lower your interest rate will be. And think about that in terms of money, right? I'd rather pay an extra $1,000 on that $10,000 loan rather than an extra $5,000 because my credit is poor, right? So this is something that you guys, before you enter that real world, you start to think about things like that. So you're not wasting money on interest and fees. All right, guys, so we're going to talk about the different types of loans, okay? So there's consumer installment loans. And think about it in terms of, I purchase a home and right then and there, you know, I pay the seller, say $200,000 for that home. Right? They pay it up front and then you pay it over time. So essentially in installments. You can think of it in terms of student loans as well. You know, when you go to school, you get $20,000 in student loans. That bank or lender is going to pay your tuition up front, but then you pay them back over time in what we call installments. All right. So installment loans is equal payments over a set period of time. You also have revolving loans. So think of it as a revolving door. It's based off of every time you walk through that door, it's based off of what you borrow. So I got a credit card, I buy a pair of sneakers for $100. I walk through that door, I pay that $100 back. I buy some gas for $50. I'll walk through another door and I pay that $50 back in gas, right? So it's revolving and it's only based off of what you decide to borrow. It's not some upfront amount that you pay over time like installments. It's what you decide to use. So I got a credit card with $1,000 limit. Am I going to use that whole $1,000 limit? I encourage you guys not to. When you're borrowing using credit cards, you want to make sure that you're using a responsible amount, because at the end of the day, it's not free money. You got to pay it back. So revolving loans, again, is based off of what you borrow. And a good example would be a credit card. All right. So with loans and borrowing and debt, there's different types of credit, right? So there's secured and unsecured. Think about back to that house, right? So I bought that $200,000 house. When that lender gives me that loan, they're going to say, okay, I looked at her history, but at the end of the day, we're going to secure this asset. We're going to back this loan up with this asset that she's purchasing, which is a house. So if I don't pay my mortgage, guess what? They're going to take my home. Think of it as with a car as well. You know, I'm sure you probably heard of somebody getting their car repossessed because they didn't pay back their loan. It's backed by some type of asset. So they're going to say, if they don't pay this loan each month, I'm going to take the car. So those are what we call secured loans. Then you have things like unsecured loans. There's no collateral. There's nothing backing up this asset. So if you don't pay, then there's nothing they can do about it besides, you know, put your account in collections, and now it's impacting your overall credit score. Think of it like a student loan. When you pay for your tuition, they're not going to take your college education. They can't take that away from you. They can't take your degree away from you, as well as credit cards. They'll probably, you know, close out that account, but at the end of the day, they're not taking any property away from you. So those are what we call unsecured loans. It's not backed by anything. I hope that makes sense, guys. And if you have any questions, I know I'm talking fast. We only have 45 minutes. You can put those questions in the chat as well. All right. So let's look at a quick scenario. We talked a lot about loans and borrowing. Let's take a quick pause and look at a scenario, right? So if you, and I don't know, Mary, if everyone can chat, right? Or respond in the chat. Okay. So if you were financing a college education, right? What type of loan would you get to finance your education? Would you get a consumer installment loan, a credit loan, or a home loan? And I want you guys to put that in the chat. And I can't see the chat.
There is nothing in chat for you to see. So, we got one from Mrs. Matzak's class. Can you see it? Yes, you should. Can you see the chat?
Okay, yep, now I can see it.
Oh, there we go. Some of these, the first one is a full classroom, and the second one is an individual student. Oh, they're coming in now.
Yeah. All right, good. So a student loan, personal student loan, and I see Brendan hit it right on the nail, right? So what type of loan is a student loan? Is it installment or revolving? So we got mixed responses here. Good. I like to see those coming in. So it's definitely installment versus revolving. So if I got a student loan, right? Am I expected to pay that up? Am I expected to pay up front everything I borrowed? So I borrowed $10,000 to pay my tuition for one semester. Am I expected to pay that up front? No, exactly. So it's called installments because you're paying it over time, a set amount over a period of time. So that $10,000, you won't be expected to pay that back until after you're done with school. Once you get your degree, once you start working, now they're going to say, okay, James, you're going to have to pay this back over a period of time. You know, whether it's 3 years, 5 years, 10 years, they're going to set an amount based on your income. And they're going to say, okay, you got to pay your student loan back $100 a month over the course of 5 years. That is an installment loan.
For everybody that's participating in the chat, I'm giving you a ticket. So
now another example. So if I was to, I decide that I want to go to Macy's and buy a pair of boots, right? And I want to make small purchases at a department store. So I'm buying some boots for $100. What type of loan am I going to get? Is it an installment loan, a credit card, or a home loan? Yes, thank you guys. It's a credit card. And credit cards are a revolving loan, meaning I only pay back what I spend upfront. So I buy those $100 pair of shoes, and at the end of the day, that's what I have to pay back. Even though my credit limit may be $1,000 or I have a credit card that's $2,500, I'm only paying back what I spend. Now, this is very important. Credit is not bad. If you play the game right, it could be a tool to help you secure your financial future, but you got to know how to play the game. And we'll get more into that in a second. Thanks, guys, everyone who commented. Thank you guys for participating. So next, we're going to talk about truth in lending. We'll just touch on this real quick. Pretty much like a lot of us adults, including myself, when we apply for loans, when we apply for different things, we don't read the fine print, right? So there's always fine print. You get a credit card application, they're going to show you your summary up front, but then there's going to be pages and pages of documents of fine print that disclose all the different terms of what you're borrowing, whether it's a credit card or a home loan. And a lot of us, we don't read that information. But what was established years ago is called a truth in lending disclosure. So now banks are in this for the money. They're not these pretty organizations that just lend out money for free. They're doing it for something in return, right? So they're charging you fees, they're charging you interest. And what they have to do is they have to be honest. And truth in lending is pretty much what it says. They have to be honest about what fees they're charging you. It can't be this little hidden fee in the back that you don't know about, or it can't be an interest rate that you don't know about. They have to be upfront on how much it's going to cost you to borrow this money. And they have to let you know what your total payment is going to be at the end of your term. So for example, back to our purchasing that car for $10,000, you should know upfront what you're going to be paying, what your total cost is going to be at the end of your loan terms. All right, so that's truth in lending disclosures. Everyone should read the fine print. Don't be like us adults who skip past that information sometimes. Read the fine print. And if you don't know, it's pages and pages of documents. Call them. Ask them these questions. What is my APR? How often is that calculated? What is going to be my finance charges? And at the end of the day, before you sign those documents, ask the questions. What is my total payment going to be? Because at the end of the day, all they want you to do is sign in that dotted line and keep it moving. But you have to understand whether or not the asset that you're purchasing is worth it, okay? So ask those questions. So here's an example of understanding and reading that fine print, right? So this chart shows you what your annual percentage rate is. So 12%, not too shabby. At the end of the day, if you got a $5,000 loan with that 12% interest rate or annual percentage rate, you're going to be paying it back $600. Straightforward. So at the end of at the end of the day, you're going to be paying $5,600 back, right? So again, credit is not free. You have to decide, is that extra $600 worth it or not? All right. Now, earlier, we talked about credit cards, right? Nothing wrong with credit cards. Like I said, once you guys turn 18, you're going to start getting offers in the mail, but it's okay to have credit. You know, when lenders look at your history or your behaviors, you got to have something there. So some people may be told, no, you should steer away from credit cards. They're not good. You could get into a lot of trouble, which is true. Borrowing money requires a lot of responsibility. So you have to be responsible, right? But if you know the game, if you play the game right, you can win in this industry, right? Or you can win with borrowing money. So if you have a credit card and you repair someone asked about a pre-penalty fee. So that is another way that lenders make money. If you decide that, and every lender's terms are different. Some may not charge pre-penalty fees, some may charge pre-penalty fees. So these are the types of questions you should be asking as you're going through the application process. You know, for example, if you buy a car and you decide, you know what, I got a little extra money, my parents gave me a couple $1,000s, I can realistically pay my balance off. They may charge you a fee or they may not. So that's a good question to ask up front. I'm sorry, I'm just going back because I see some questions in here that I didn't get to. So one question was, if you pay the interest while you're going to school, will this lower your fixed payment when you graduate? That is a great question, and that is a good strategy. Absolutely, because at the end of the day, when you're paying back that loan, you're paying back your principal, your interest, and any applicable fees. When it comes to a mortgage, you want to add in taxes as well. So you're paying that all back within the monthly payment. And if you decide that, you know what, I'm going to start paying my interest while I'm in school, then that's fine as well. Great question. Great question. All right. Back to credit card. So paying only the minimum payment can be very costly, right? So if I buy a TV, I don't know. I don't think we can get TVs are pretty cheap nowadays, but just to say, okay, I buy a TV for $500 on my credit card and it's an 18% interest rate. So at the end of the day, I'm paying an extra $132 in interest, right? However, there's a game. If you buy that TV for $500 and you pay it back before the grace period, and again, every credit card has different terms. So say their grace period is 20 days. I buy that TV for $500, and within 15 days, I pay that $500. I'm avoiding paying that interest and any applicable fees that the credit card company may charge me. So there's a way to play the game so that you're not spending a bunch of money in fees. Now imagine if I paid I brought that TV for $500 and I don't plan on paying that TV off for another year. So I'm just paying my little $25 minimum. You're going to be paying a lot more for your original purchase than you planned. And again, the higher the amount, look at this furniture. The higher the purchase amount, the higher the interest paid, right? So if I buy a couch, a living room set for $2,500, and I decide, you know what, I'm going to take my time paying this, right? At the end of several years, I could be paying twice as much as the furniture set costs. So when you're considering credit and borrowing, you want to make sure that you're being responsible for it. Use it as a tool to build your credit. Don't just borrow just to borrow. Don't just spend just to spend. You're young. I would suggest that you guys use it as a tool to start to establish credit. So even though you may get a credit card for $1,000, don't plan on spending that whole $1,000. Maybe use it, set a goal to say, okay, I'm going to spend $50 a month because I know I can realistically pay that $50 a month back before the grace period or before the end of the month is over. So again, credit can be utilized as a tool to establish.
About whether the APR stays the same if you're using the same credit card.
It should. So the credit card company would disclose or should disclose whether or not your APR has changed. So they can't just say, okay, your APR is 18% today, and then 6 months later it's 24% without notifying you of that change. So someone asks, does that mean that I shouldn't use a credit card on very expensive things? So define it. So what's the plan? Are you going to use it on an expensive thing and pay it back, or are you going to use it to let it sit? That's something that you should factor in. You know, what's the intent of buying that expensive thing? Because at the end of the day, it boils down to how much is that expensive thing really going to cost me? You know, if I buy, if I buy a refrigerator for $1,500, that refrigerator is not going to go anywhere. I'm going to plan on having that refrigerator for a while, and I could decide, okay, I'm going to take my time paying this back. But then again, with the scenario that we had before, now that refrigerator costs $2,500 instead of the $1,500 that you originally intended. So if your goal is to buy that expensive thing and then pay it back, by all means, go for it. So I personally don't have a bank recommendation for opening a credit card. I would, because there's so many out there. There's so many out there. I would suggest try going with your local bank, right? Start there. You know, start at your local credit unions and begin there, because you already have a relationship established with them. So you can begin there. If you use any amount of money on a credit card and don't pay it back in a certain amount of time, will it cancel your credit card or do something else? So pretty much when you buy on credit, you pretty much there's a due date that you have that you have to pay back the funds. And it's not the full funds. They'll say, and we'll get into that in a second, they'll have your minimum payment, what your total balance is, and it'll be due just like any other bill at a certain date. So I have a Chase or Capital One credit card. My credit card bill is going to be due on the 5th of every month. So I have the option to pay off my full balance on the 5th of the month, or I have the option to pay the minimum payment, say $25 every month. Now, if you don't pay it, so if you don't pay it for 1 month, you're like, dang, I was so busy with classes. I totally forgot, I was working, exhausted. I forgot to pay on the 5th of the month. So I decided to pay on the 20th of the month. What they'll do is they'll charge you a fee. They'll charge you a late fee. So now instead of that $25 minimum payment being due, now it may be $40 because they charge you a $15 late fee. Now, if you do that consistently over the course of several months, yes, they might cancel your credit card. And now it's not only impacting your ability to borrow money, now it's impacting your credit. your credit score and your credit report. Now, other lenders are going to see this information, and they're going to use that to determine whether or not they'll let you borrow money. Great questions. Right. So looking at your credit card statement. So touching on what I just spoke about a second ago, when you get your credit card statement, it's going to give you all of those details on what you have to pay and when. It'll tell you what your previous balance was, what your new balance is. So within that period of time, you may have purchased something new. It'll show that on your credit card statement. It'll show your credit limit. So your credit limit is the maximum amount that this lender is allowing you to borrow. So say, for example, $1,000 credit limit. If you go over that $1,000 credit limit, they're going to charge you fees. And again, like someone said, they may cancel your card. Credit available is the amount that you have not spent. Again, remember, revolving is only what you have spent. So I have a $1,000 credit limit, but that prior month I only spent $100. So now I have $900 available credit left. And then it'll also show your payment information. So what your new balance is, what your minimum payment due is, what your payment due date is, and then any late payment warnings. Okay. So when you're applying for a credit card, and these are just some key terms for you guys to get yourselves familiar with. Obviously, when you're applying your credit as a credit card applicant, you're the person applying for a credit card. The creditor is the company that's issuing you that card. And when you apply for credit, typically you're applying on your own, right? So that's the individual credit. If you're married or, you have a parent that decides to get on the account with you, then it becomes a joint credit card. And then an authorized user. So again, a lot of parents, they allow you to be an excuse me, I'm trying to move the chat. So when an authorized user is when someone allows you to use your credit card account who has no responsibility to pay the bill. So think of a parent-child relationship, right? I'm just looking. Okay. And that is a good way to start to establish credit. If your parent has a credit card, they can add you as an authorized user, but at the end of the day, your parent's going to be responsible for paying that bill. Okay.
We are coming up on 8:30. This has gone by very quickly.
Yes. Okay. So how many more minutes do we have? Just like a couple minutes? Yep. Okay.
Here's what I would say. Let's do this. We'll stop at 8:30. I'll give the lowdown for the day. And then if anybody has questions, they can stay on with you for chat. And anybody that needs to jump off can do that.
Okay. Sounds good.
All right, so I'll give the lowdown for the day today now, and anybody that wants to stay on can do that, and we can finish up. Anybody that needs to jump off can. I've taken a lot of names here from people, so I will draw 4 I will let you know. I'll draw for 2 Dunkin' and 2 Starbucks. So I have a ton of slips here. So I will go ahead and announce those tomorrow morning. I will be sending out an email to the teachers pretty closely to the end of this with a link to the video to use with other classes, plus information about how to access tomorrow morning's class. All right, with that, go ahead and finish up. Anybody that needs to jump off can. Anybody that can stay on, please do.
Awesome. Thank you guys for joining. And for those who are staying on, I just want to go over, this slide real quick about co-borrowing and co-signing, because this is so important. My husband and I have been in a situation where sometimes everyone may not be eligible for credit, but what the lenders will do is say, you know what, you can co-sign, it's somebody else on top of you that they may find reliable, trustworthy, that can co-sign. But there's a big warning with that, because if you co-sign someone's loan, you ultimately become responsible at the end of the day. Even though you're doing it for them, if they decide not to pay, it's going to impact your credit as well. So definitely be aware of co-borrowing and co-signing with other people. And for those who are still on, if you guys have any questions, I'll be on for a few minutes to answer any questions you have.
Looks like the majority of people are still on, so.
Okay. What questions do you guys have? I know it was a lot of information. Okay, so awesome. So is co-borrowing risky? Absolutely. At the end of the day, think of renting an apartment, right? You have a lease term and you're renting an apartment. You and your friend are on that lease. Your friend decides that, you know what, I'm going to be irresponsible. I'm going to quit my job. I don't feel like working anymore. Now I can't afford my part of the lease or the rent. So you're each paying $1,000. You're paying $1,000. You each pay $500. At the end of the day, if your roommate decides not to pay, you guys are both still responsible for paying that rent every month. They're not going to say, oh, Jimmy, he lost his job. They're not going to feel sorry for Jimmy. At the end of the day, they're going to look at both of you to say, I need my $1,000 rent payment every month, right? So it's definitely risky. Beware of any signing a dotted line with anyone, even your parents. You got to come to a mutual agreement that this is a good idea for both of you guys, because at the end of the day, you're both going to be responsible for paying that liability back or paying that debt back. Is it bad to have too much credit cards? I would say yes. Starting out, you're young. You don't need 5 credit cards. You may see some videos on YouTube or on the net with people saying, I got 5 credit cards. My credit limit is $15,000, $20,000. That's great for someone who is established, because a lot of times the more credit you have, that it's a good thing, because it can help with your debt to income ratio. But at the end of the day, if you don't have the means to pay those credit cards back, what's the point? I would say start small with 1 credit card, get established, and then go for more. And have a goal in mind. Don't just go for more just to go for more. What are your goals? Are you trying to establish more credit to make a big purchase or something like that? So always have a goal or your why in mind for why you're trying to get more than 1 credit card. If you are an authorized user on your parents' credit card, will it help your credit score if they pay on time? Absolutely. It could, just like with anything, it could hurt or help. Any other questions?
If we don't have any more questions, and if you do, if you're in the middle of typing, you'll have a couple of minutes here, so don't worry there. If you have any more questions, please feel free to type them into chat. If you don't, I would love to thank Rashea Schand from the Money School for being here today to speak with us about credit. I think this was an amazing and a very important lesson for our high school students who are getting into the world of credit and car buying and apartment renting because this is something that they are going to be using as they move forward in their lives. So thank you so much for being with us today.
Thank you for having me. I really enjoyed it.
Oh, there is one more question in the chat.
Could you use your credit cards to pay for rent? You can if your landlord accepts credit card payments. Typically, a lot of landlords will take a check. Some will take cash. But if they author or if they allow credit card payments, you can. Now, is that a smart idea? I would say not. Again, if it's an emergency and you had to use your credit card to pay rent, then I would say go for it. But again, at the end of the day, you have to pay that back with interest. So keep that in mind as well.
All right. Well, and I do think it's important to note there is a big difference between your credit card and your debit card, which might say Visa or MasterCard on it. So if you use your debit card that's coming out of your bank account, that's not a credit card. It won't charge you interest. But if you use a true credit card, it would.
That's funny. I just posted a video on Instagram of my son, my 8-year-old son, explaining debit card versus credit card. Debit is your money. Credit is not your money. So it's borrowed money. Yeah.
All right, that's awesome. Thank you so much. For everybody else, we'll see you again tomorrow morning. And I will be getting this video out to the teachers ASAP. All right.